everyone? Nash Middleman here, back with the last episode of the Affordability series. Really looking forward to talking to you guys about PITI today. What is PITI? PITI is the principal, interest, taxes, and insurance. And the reason I wanted to cap off this series with talking about PITI is I want people to be aware of the phantom costs of owning real estate. Coming up next, we got a great series that's going to be more geared towards sellers and how to design and get the most money out of your house. But nonetheless, this is full circle with the affordability series, and I want just people to be aware of the phantom costs of owning real estate. So let's get into it. Shout out to my girl today. It's her birthday. Audra, I love you. Happy birthday. As tribute to you, I'm drinking out of the Mexico City mug that you got, and she got her lashes done in Oakland, and I went to Bicycle Coffee, and I got this nice little light roast, sustainably farmed Arabica coffee bean blend. It's a nice blend of fruity, juicy, vibrant 12-ounce bag. And what I love about Bicycle Coffee is that you get a free cup of coffee if you buy a bag of beans. And I just think that's a great value. As somebody that prides himself on great deals for their clients and great value, providing great value, that is a great value. I got a free cold brew and really appreciate that. So thanks, Bicycle. I also think bicycles and coffee just go really well together. So I think they nailed it with the concept of bicycle coffee. I also love bicycles and I love coffee, so I am their target market, which I appreciate. So shout out to Bike Coffee. But nonetheless, I want to talk to you guys today about PITI. What is PITI? PITI is your principal, interest, taxes, and insurance. It's the acronym. Lenders will do a great job calculating your principal and interest to a cent. But I want to talk about why it's important to use a local lender during this podcast and let you guys kind of be aware of the nuances that can creep up on you when getting ready to purchase a house. So for the sake of this podcast, we'll imagine that buyers new in the market, they're getting ready to buy a house, and they got an estimated statement of what it might look like to buy a house. Now, like I said, your principal and interest will be very accurate. Your taxes and insurance may fluctuate depending on where you buy. And sometimes lenders don't fully grasp how that can fluctuate and what the cost might be. So imagine that you're getting ready to buy a house. You got the statement. First thing we'll talk about it is the principal. Principal balance of a loan generally won't change when you own that house. Something to be aware of is that your principal, your monthly payments over the course of that loan is going to be mostly interest in the beginning. And the way that those loans are amortized over the life of having them, of owning the home, about halfway through, your payment will be half interest, half principal, and then the last payment will be all principal. So what I like to coach buyers on is there are many options out there when it comes to mortgages. A lot of different products. 30-year fixed mortgage is probably the most common. But most buyers are in the home for 5 to 7 years as a first-time home buyer. The interest that you're going to pay over the first 5 to 7 years, the monthly payments are going to be mostly interest in the first 5 to 7 years anyway. So it makes sense to shop around and, just know you're going to be paying mostly interest in the beginning of owning the house anyway. So just something to keep in mind. Also keep in mind, real estate is not a get rich quick scheme. It takes generally 5 to 7 years to really see the rewards of owning real estate. But I would just say, as you're vetting lenders, ask them about maybe some other niche products that they have, and just know your principal, the way that the loans are amortized, the principal will get paid mostly at the end of that loan. Also important to know, if and when you refinance, that principal balance doesn't change. Only the interest changes. And with us being in a high interest rate environment, it's actually not a bad time to buy real estate because your loan balance will probably be less than it would if there was low interest rates and a lot more buyers in the market. So the smart thing to do, and what I'm also coaching a lot of buyers on, is buy at a time when interest rates are high and then refinance the loan when rates go down. Interest, the second letter in the acronym PITI. We are in a high interest rate environment. There's no doubt about it. As of today, the 10-year Treasury yield, which is the best metric for measuring what a 30-year fixed mortgage would be, is about 4.5%. Mortgage rates want to go down really badly. They're trying, but there's always new data that comes out that affect the pricing of these loans in the 10-year Treasury bond yield, excuse me. There are so many factors that impact interest rates, employment, inflation, the stock market. Anyway, just like so many different things out there that are going to impact the interest rate market, that it's kind of a fool's errand to wait for interest to go down. Cool thing about paying interest is it's actually deductible on your taxes. It will lower your tax liability with some restrictions, but paying interest is not a bad thing. It is one of my least favorite things to pay for. I will say that. Um, Also, if you shop around, you could probably get a lower interest rate through banks that have niche products in, say, low to moderate income census tracts. Or you can get creative and get the seller to buy down the rate for you. So there are ways to get lower interest rates, but interest is a big variable in that equation. And make no mistake, we are in a high interest rate environment. So like I said, lenders will give you a very accurate quote for principal and interest. Sometimes the taxes and the insurance will not be super accurate, and that might be because they're an out of area lender. It might be that the property is in a high fire area, and that's really what I want to talk to you guys about today. So the next letter in the equation, taxes. Taxes is a fun one because actually the tax rates all over the Bay Area are gonna vary wildly. In Alameda County, Contra Costa County, it's about 1.5% of the purchase price. San Francisco, I think Mill Valley, it's closer to 1%, but the price points can be a little bit higher. So you have to understand the nuances and actually get a very accurate idea of what the monthly taxes are going to be. Sometimes lenders don't understand that the taxes are what they are, and they will misquote you on that portion of the monthly payment. But you want to get a really accurate idea of that, especially when you're shopping for a property. So you're shopping within your means, and you're not surprised once you're in a contract and you don't have any contingencies or a way to back out or negotiate if you figure out that the monthly payment's going to be too high. So let's consider for a second you're getting teed up to buy a house, right? Property taxes is just a portion of the monthly payment, but it's also one of the biggest reasons that people invest in real estate. Your property taxes under Prop 19 will only go up 2% a year. Now, there are situations where your assessed value could change. Anytime real estate changes title, the property value will be assessed. But while we're talking about taxes, it's not just the property tax that you're always on the hook for. There are also closing costs where they have what are called city and county transfer taxes linked into your closing costs. So important to be aware of that. That's going to change vastly depending on the city and the county as well. There's also a hack called Prop 13 where seniors can actually move their tax basis if they want to buy another house in California. And why is that important? Well, say you buy a house and you're in that house for 15 years. The appreciation of owning that home is going to far outpace the 2% annual increase in taxes that you're going to get. Also, keep in mind you're paying down the principal. So that's why real estate is just such a great way to, build wealth. As you're paying down the principal, your house is also appreciating. But anyway, seniors under Prop 13 can move that tax basis if they've been there for 30 years, for an example, And that is such a huge savings. I think people get such paralysis, or seniors get such paralysis because they don't know about these tax breaks that they could get if they purchase a new house. Say they want to downsize and they've been in the house for 30 years and their tax basis is super low. Under Prop 13, you can actually move your tax basis and keep a lower payment, keep a lower tax basis if and when you buy another house. Also, if you buy a multifamily property, the IRS is going to look at that multifamily property like half of it is your primary residence, so you get all the tax benefits of owning a primary residence, and the other half is an investment property, which you get even more tax breaks from owning an investment property. One of the biggest ones is depreciation. So you can actually depreciate the life of the structure over 27 and a half years, which is crazy because as real estate is appreciating, you're paying down the principal, but you also get tax breaks because in the eyes of the IRS, it is a depreciating asset. So just some fun little tips when it comes to taxes. But going back to PITI, property taxes is going to go up 2% a year, and it's going to change wildly based on where and when you buy. So just a few things to be aware of when it comes to taxes. All right, so lastly, insurance. Insurance is probably the reason why I wanted to do this whole affordability podcast, because it's such a hot topic right now. There are a lot of things going on in the interest world. And especially in like all the high fire desirable areas that make up the East Bay and the San Francisco Bay, I think buyers need to be really cognizant of like what it could cost to insure a property. So remember, again, we're getting teed up to buy a house and you got to estimate a statement from your lender. Now, that might be very accurate in terms of principal and interest, which they're great at calculating. Taxes are going to fluctuate, and interest is also going to fluctuate wildly based on where you buy the house. If you're purchasing a property in a high fire area, interest could be up to $10,000 a year. And I say that because I just had a past client who got dropped from their insurance company and had to pay this exuberant amount for a new insurance policy. And I'm trying to think what that is. What's 10,000 divided by 12? Like $700-800 a month. And I don't love saying this, but I think it's the truth. Is like insurance is going to go up everywhere. I mean, we just got a new article that came out in the LA Times last week where the California Fair Plan is basically underwater, and they're talking about a bailout for all of the policies that are the California Fair Plan. And we don't know yet how that's going to affect everybody, but what they're talking about is all of the admitted insurance carriers, basically carriers who are regulated by the Department of Insurance, are gonna impose surcharges on their policies. So even, and I'm speculating here, but even people who aren't in a high fire area are going to see an increase in insurance. So insurance is a sticky topic. I'm also doing another podcast with Free Model coming up, and they offer a really cool service where they will actually front people money to repair their houses, and then you pay it back at the close of escrow. And the reason I bring that up is because I think it's a great product for somebody who wants to make their house more insurable. Somebody that wants to redo the roof, the electrical, the plumbing, make sure the systems are updated so that when buyers come in, they're not paying exuberant amount for insurance because the house is actually more insurable. And I just think it's a great product too, because they will front you the cost, right? Sellers don't have to dig into their equity or, I don't know, get a HELOC at like 10%, full circle on interest rates there. HELOC rates are like astronomical right now too. So that's a great option for anyone who's thinking about selling. Anyone that wants to like move their tax basis, downsize, and make their house more insurable for prospective buyers, like that's should listen to this. Anyway, Yeah, insurance is a tricky one in California. It's such a hot topic right now, and I really feel like insurance is going to go up across the board. And that is one of the phantom costs of owning real estate, right? Principal and interest generally won't change unless you refinance the property, pull some equity out, what have you. There are some great rewards that come with owning real estate, some great tax breaks that come with owning real estate. Generally, they'll go up 2% a year under Prop 19, but there's also all these hacks that you can use the tax code to your advantage. And then insurance is probably going to go up. It's not going to go down. And that's just something that I think buyers should be really cognizant of if and when buying a house in California. It's such a hot topic right now, and it remains to be seen how these LA fires are going to affect policies in all of California, not just the high fire areas. But it's just really important for anybody that's getting teed up to buy a house to get a really accurate idea of what it's gonna cost monthly when you own the house and as you continue to own the house. Now, again, I could talk for days about the phantom cost of owning real estate. It's really important that you go in with your eyes open and make sure that it's a sustainable payment for you so you're not in a situation where you're one house poor or two like underwater on a house because you can't afford to fix the roof that you didn't know was going out. But for the sake of this podcast, I just think it's really important to talk about like what it looks like to buy a house and some of the nuances that you have to be aware of if and when closing on a house, right? Because principal and interest are just such a small portion of it's just the tip of the iceberg. Principal, interest, taxes, and insurance is your whole payment, but that's also going to change. A couple other things that I also want to touch on is like there's going to be some other nuances there. Say you put down less than 20% on a property. On the insurance topic, you're also going to be on the hook for what's called PMI. PMI stands for private mortgage insurance, and it basically protects the lender against the buyer defaulting on the loan. There's also these closing costs that come with buying a house, and part of those are your title insurance policy, right? To make sure that the buyer gets a clean title when they take ownership of that house. And then there's also what's called a supplemental tax bill, which in my opinion is the stupidest name for what it is. The supplemental tax bill is basically the difference in assessed value from the time that you take ownership of the house to what it was assessed for prior to you taking ownership of the house. So say somebody bought that house for 500,000, that was the assessed value. Then you bought that house on February 17th, today, for $1 million. There's a $500,000 difference in the assessed value. Now, if and when the tax assessor catches up to that assessment, and it will, you're going to get a bill in the mail for the difference in assessed value. And make no mistake, they want every dollar that is owed to them. And sometimes it takes up to 2 years for them to do this assessment. Generally, they're a lot quicker, but I just had a buddy who got his 2 years later after he bought a house in Solano County. So maybe they're a little bit slow over there, but it was a couple grand that he had to pay in taxes. Supplemental tax bill is a one-time fee, but it is the prorated difference in amount that buyers are on the hook for if and when they close on the property. So hopefully that gives you guys a little bit of like nuance as to what the phantom costs of owning real estate could be. It's not just principal and interest. Taxes and insurance are a huge piece, and there are ways to navigate it so that you're saving money and not paying a premium. So if this was helpful, give me a like, a follow, text me, let me know that you liked it. Really appreciate you guys listening. Happy birthday to my little lamb chop, and looking forward to the seller series that's coming up at the end of February for all the sellers out there, just in time for the amazing spring market that is upon us. And cheers. Thanks for listening.